Hi, this is Phil Greenwood, and this is our second in a series of podcasts on financial statement backgrounder for the Wisconsin Entrepreneurial Bootcamp. And in this brief section, we're going to touch upon the income statement, talk about some of the terminology, and look at the semantic income statement for the related time frame we had used for the balance sheet. The income statement tracks, remember, the economic activity for the company over a period of time, be it a month, a quarter, or typically in this example for a year. It'll look at the revenues, in other words, what are the sales the company made during a particular time frame, but it also will track the cost of goods, cost of sales, or what we call the cost of goods sold, the cost to actually produce the inventory or the products, the cost that we produce to produce it, of the product or service that was sold. Critical is to understand the number called gross profit, which is simply revenues minus cost of sales. It tells us what's left over after sales to cover the remaining expenses of the firm. As we'll see within an income statement, you'll have a category called operating expenses. These are also called period expenses, meaning that they're expenses the company makes and spends over a time frame that we can't specifically attribute to a particular unit of sale, but are still necessary in running the operations in order to create the sales and the cost of goods sold. You'll see categories like selling, general, and administrative expenditures, which include a lot of salaries, commissions, and such, but also R&D, research and development expenditures, expenses that are being invested that are hopefully the company will receive future benefit from, in new products and new services that they'll offer many years in the future. You'll also see components of expenditures classified as depreciation or amortization. These are expenditures related to long-term assets that the company purchased, that the company will spend a certain amount of money for, say, a machine, and we expect that machine to last more than a year's time. And so what we do is we say that the cost of that machine, we put it on the balance sheet as an asset, and then we reduce the value of that asset over a certain number of years to match the use of the asset with the benefit we receive. Amortization is just like depreciation, except amortization is related to intangible assets like goodwill, patents, and such. Hopefully, revenues minus cost of goods minus operating expenses will generate operating gains from the company. And then after paying taxes and any interest expense and any miscellaneous things, there'll be some resulting net profit that can be used to either pay out in the form of dividends to shareholders or kept in the business to help fund future operations. So when looking at Symantec's income statement related to the balance sheet we talked about before, here you can see the income statement for both 1991 and 1990. If you recall, the balance sheet, there were significant changes in the balance sheet, specifically from the asset side of the accounts receivable. Well, accounts receivable is what customers owe us for any revenues or sales we made. And so the increase in Symantec's accounts receivable is somewhat related to the increase in revenues you can see from 90 to 91. Now, the category called cost of goods sold, that's the cost of to manufacture and develop the inventory that was sold. In other words, in their case, they used to sell the software by books and CDs. Whatever the cost that went into acquiring it, building it, and then shipping it, that is the total cost for that particular year in relation to the sales. As you can see, they have a healthy gross profit for 1991, significantly up from 1990. And the company spends a good deal of money, operating costs or expenditures, in the form of research and development, sales and marketing costs, and then the what's left over, general and administrative. This would be like human resource costs. This would be costs for an accounting department. Any expenditures not related to sales, marketing, research and development, or manufacturing that cannot be traced specifically to the product. Key thing to note is the gross profit less the operating costs equal a component called EBIT, EBIT. What that stands for is earnings before interest and taxes. We also call that operating profits. That gives us a good sense of how effective the company is generating profits from the operations of the organization. The interest expense that you see here In this case, you can see it's a negative number, so in fact, that's income because, as you can see, earnings before taxes, we're basically taking EBIT minus a minus number, and so we're actually increasing the earnings before taxes, so that's interest income. We then subtract out the income taxes owed for federal and state income taxes, and what's left over is net income. So this kind of gives us a snapshot for the year's activities of how well the company's done, both from a revenue standpoint and a profitability standpoint. I think the key thing to note here is that revenues increased from over 74 million to 116 million, but profits stayed pretty much the same from year to year. And so one of the things we'll want to delve into in future podcasts is ways we can analyze that, not just to eyeball the numbers, but why that occurrence took place. Because gross profit went up quite a bit, but as you can see, R&D, sales and marketing expenses increased dramatically, much faster than sales increased. So in recap, remember the balance sheet accounts are comprised of assets, liabilities, and equity. The assets must equal the liabilities plus equity. Assets, another way to look at it is the assets must equal the liabilities plus the original equity that was in the business at the beginning of the year plus any net income that's kept in the business. And in the income statement, we'll see accounts like revenues related to the sales of the goods or services and any other income the company brings in, less the expenditures, both in the form of cost of goods sold and operating expenditures and taxes, to give us a sense of what the net income or net loss is for the business.